So if you take all the major corporations that have trash out here in the Bay right now, you track their stock performance, that would be an indexing strategy for an annuity or a universal life insurance plan. So in mutual funds, you would actually invest in the top largest performing stocks of a certain index like the S&P 500, which would act as a good barometer as to how the whole index is performing in its entirety. But in a universal life or annuity, you're just tracking the index itself. So the S&P 500 would be the only thing you track. Because you're not actually invested in it, you don't actually have the risk of losing money on the performance of that security. The company you did your plan with will just base the index crediting method off of the performance of that index, as opposed to being invested in a mutual fund where you are actually invested in these large cap companies. So therefore there's more of a risk there of those individual companies maybe doing worse than the actual index itself. However, there's also much of a larger chance of a potential reward, whereas in an index universal life or annuity, you're actually capped on the growth of the performance. And in return for that cap on your growth, you often get a minimum guaranteed interest rate that you'll get no matter how poor the market actually does. And so in an index universal life or annuity crediting strategy, you're actually just trading off some growth for security.